So what I'm going to talk to you about today, just for sort of 45 minutes, a brief introduction really on charity accounts and reporting requirements for charities, because they can be quite complex. So what I wanted to kind of the aim for you to get an understanding of by the end of this is what actually are the reporting requirements for charities and for different types of charities. Go through some of the accounting principles and how you are different probably from most corporate entities and maybe from what you've maybe seen in other areas. Talk a little bit about the Trustees Report and cover off some accounting oddities.
Okay, brilliant. Good to know.
Sorry, if you could just, I don't know who that was, if you could keep your microphone on mute, that'd be really appreciated. So types of charities, there are four main types of charities really, and I think if we start with the most simplest, it's an unincorporated association. So these are not a legal entity in their own right. So trustees and anybody connected to the charity does not have, they have unlimited liability effectively, but they are simpler to run. They don't have compliance with the company's house or any of the company law. So they're the smallest and probably the most simple type of charities that we come across. Largely used with kind of small sports clubs, things like in schools, kind of parent teacher associations, those sorts of charities. The next type of charity, which we've had around for many years, is a charitable company. So in this case, the charity is a legal entity in its own right. So that does give limited liability to the trustees. Now, normally they're what's known as limited by guarantee. So they don't have share capital compared to your sort of normal, conventional, traditional company, but they're limited by guarantee, which means the members, who are very often the trustees as well, guarantee in the event of the charity being wound up, they will have put a personal guarantee in. But that personal guarantee is normally either £1 or £10. So it's actually a very notional liability that they've guaranteed there. So this is really useful for larger charities. It gives some personal protection to the trustees, which can make them more comfortable, I suppose, if you're looking to recruit new trustees. Now, this sort of charity, it is a charitable company, as it says there. So they do have to prepare company accounts or accounts which comply with company law as well, and their accounts also do have to be filed at Companies House. So they've got some slightly increased reporting requirements in comparison to the unincorporated association. The next type of charity we got is relatively new. When I started my career, this type of organisation did not exist. So the charitable incorporated organisation is probably 5 or 6 years old now, but it gives a lot of the legal protection that the charitable company has. So it gives a limit to the liability of those trustees and of those members, but it is not registered at Companies House, so it is purely a charity. It's a good option, and it's something I see a lot of new charities when they're set up now being set up as a CIO, and also I do see quite a lot of unincorporated associations transferring into this type of organisation to give them that protection which they have. The final type of charity, which is probably we don't see so often, but it is still very much a type of charity, is trusts. So trusts are usually set up to put some assets aside for a charitable purpose. The advantage of a trust is they do not have to set charitable objectives when they're set up. Effectively, just charitable purpose as a whole can be their aims. What this means is you can put somebody can put money aside into a trust and then pay it out to a range of other charities, a range of other projects, depending if what they want the money to do changes over time. So trusts are more often than not sort of a vehicle for putting some money aside and then dispersing it to other charities. Whereas the first three charities I've got there, those are more the sorts of charities which are doing and are delivering charitable activities. I'm sorry, I just want to check. Can everybody see the slides? Okay, I've just had a comment that maybe not everybody can see them. Okay, I've got a thumbs up from Catherine there, so I think you all can see the slides. That's good. Good to hear. So I haven't just been talking without anybody seeing. Thank you, everybody. So those are the kind of the four main types. Oh, I've got somebody else who say they can't see them and can just see a blank screen. I'm just going to stop presenting and try and reshare my slides all for you again, because there's a few
No,
people who.
I think it could be that it's low bandwidth means that you don't get the slides. I think the vast majority have said they can see them. I think there's only one who can't at the moment. So I think that the sharing connection is working okay.
Oh, okay, thank you, Alistair. It wouldn't be a webinar without some technical hitch, would it? It's par for the course, I think.
I can now see you.
Oh, okay, I'm not sure who that was, but if you can now see them, that's good news. So I haven't changed anything my end, so I think it might be an issue with your bandwidth or something your end.
Thank you.
So thinking about reporting requirements and what a charity actually does need to do, it actually does depend on the size of the charity and what exactly your charity is doing, I suppose, really. But all charities must prepare some accounts that are available on request, and that is, regardless of your size, you have to have something which the public, if they want to see, can make a request. And every charity must file them at the Charity Commission if the income is over £25,000. So it's only the very small charities who aren't putting some information out publicly. And then as another sort of reporting threshold, you must also file an annual return with the Charity Commission if your income is over £10,000. And that annual return just gives some standing information, some standing data, I suppose, to anybody looking on the Charity Commission, just so they can understand your charity a little bit more. So all charities are doing some form of accounts, but what form of accounts are they doing, I suppose? And it does actually very much depend on how that individual charity is set up and how big that charity is. So CC 15B is one of the Charity Commission guidance documents. And if you've, to be honest, these CC documents, there's about 30 of them, I think, issued by the Charity Commission. They do guidance documents on all sorts of issues. It might be land transactions, it might be guides for trustees, it might be financial reporting. They are very, very good guidance documents. And to be honest, if I've ever got a question from anybody about sort of some charity matters, those are a really good starting point. So I'd recommend that you all have a look at those if you've ever got any questions. But these documents, they do set out what the requirements are for your reporting. So there's two formats of accounts you can do, really. There's receipts and payments or accruals. So receipts and payments is very much the most simple form of preparation. Non-company charities, so the unincorporated charities, can do these where their income is below £250,000. So it is the smaller charities, that the less complex charities have this option. And really, it is what it says on the tin. It's receipts and payments. It's a glorified cash book. You are just looking at what money has gone through the bank, what transactions have physically been processed. So it's quite a simple format of accounts, but that obviously saves costs and time for those smaller charities. So it's trying to reduce the burden on those small charities. The alternative to doing the receipts and payments format of accounts is accruals accounting. So this is traditional accounting that all companies have to comply with anyway, and all charities with income of over £250,000 must do this form of accounts. So as accruals accounting is when we're not so much looking at the kind of the cash itself, we're looking at very much kind of what is the actual transaction, regardless of when cash is received. So these accounts will contain a balance sheet, a statement of financial activities, and they will also include further kind of explanation and notes within the accounts, quite a lot of notes which will explain what's been going on in the charity, what costs have been incurred, what income have been received, for example. So accruals accounting is the more complex, but it's probably, I would imagine, probably if you're joining me today, that is probably the format of the accounts which you're probably preparing in your charity, and it's certainly the larger charities will have accounts prepared under this basis. Once some of accounts have actually been prepared as well, there are examination requirements for charity depending on your size, and what we mean here is actually an independent person coming and looking at the accounts and certifying them effectively. So the key limits really are above £1 million income, you must have an independent audit. So that's engaging in an independent firm of auditors, such as Bishop Fleming or another firm, and actually certifying the numbers, completing audit testing, looking at balances, ticking off invoices, looking at how the charity runs, all of those sorts of matters, and signing off an audit report at the end of the year. So that's probably the most kind of the highest level of assurance we've got there. Then for the kind of what I guess in the context of this, the mid-sized charity, so above that 250,000 threshold, but below £1 million, you're required to have what's known as an independent examination. And that independent examination at this income level must be completed by a suitably qualified individual. So members of Institute of Chartered Accountants, for example. And I think there is a bit of a misconception sometimes with trustees and management as to what an independent examination actually entails, I suppose. What we find with an independent examination is effectively the report that is signed is that the numbers have been properly extracted from the core underlying financial systems and properly prepared in terms of disclosures and narrative. It doesn't go to the level where the independent examiner is looking at a large sample of transactions and is kind of testing them. So it doesn't give that sort of audit assurance that you would at the next stage up. And I'll come back to that in just a second. And then when we've got the smaller charities, so the income between 25,000 and 250,000, again, you still need an independent examination, but they've sort of expanded who can complete that. So it just needs to be somebody with kind of necessary knowledge and experience, but they don't have to be a practicing member of a professional body. And then the very smallest charities, so those ones who just need to prepare accounts but don't need to publish them on the Charity Commission, there's no requirement to have any independent examination there. On the subject of sort of that independent examination and probably a slight misunderstanding from that from trustees, what some charities will look to do there, where they are just having an independent examination, is to engage an accountant in order to do some bespoke testing for them. So maybe not issuing an audit report, but maybe as a trustee you might be thinking, I'm not quite sure how we manage our finances and how our systems and processes are working, and engaging someone like Alistair, who's talking later, to do kind of bespoke work to give trustees a little bit of extra comfort around those areas. So the charity SORP, so this is the statement of recommended practice. This is, I suppose, the rule book for the accounts and disclosures for charities when we're preparing the accruals accounts. It's a very useful document, and it sort of incorporates the accounting standards within the United Kingdom, FRS 102, and it puts them in the charity concept, I suppose. Really puts them in the context of charities, because the core UK accounting standards aren't really written for charities. You've got things such as donations, legacies, lots more grants, charitable activities, all of these things which normal UK accounting standards don't really know how to account for. So the charity SORP is really useful in terms of putting all of this in the correct context and telling you how they want things to be accounted for and how they want things to be disclosed. What you will see if you ever look at a set of charity accounts prepared under the charity SORP compared to a normal corporate entity of the same size, the charity accounts will be much bigger. There will be a much bigger document. There will be many more disclosures. I don't think that's a bad thing, because we are charities, we are public interest, we've got public donors. I think it's only right that they should be getting all of that information, but it does make charity accounts a lot more time consuming and complex to be prepared and to be audited, to be honest, compared to a corporate entity that would be the same size. One of the key concepts within the SORP is fund accounting, though. So a normal company, they just have income and expenditure, they have profit, they can do what they want with their money effectively. In charities, it's clearly not the same. You're getting money from all different sorts of sources, and people putting different kind of requirements on you as a charity there. So the three main types of funds, and this is what we call them in the charity accounts, funds. We have what's known as unrestricted funds, restricted funds, and endowment funds. So almost all of these get monitored almost on their own individual profit and losses, for want of a better term. We look at each one with income, expenditure, and balances. But starting with restricted funds. So they are very common in charities, and these are funds which have been given to the charity where the donor, the person who has given you the money, has imposed restrictions as to what you can actually use them for. So it might be for a specific project, it might be for a specific bit of fundraising you've done, it might be for kind of specific delivery of some sort of service. But effectively, you don't have a choice what you can spend it on. You can only spend it on that one item. So with these sorts of funds, it's absolutely vital that the charity can properly monitor what spend you've been putting against these individual ones. And some charities can have an awful lot of different individual restricted funds, all which need to be monitored, all which need to be looked at and reported on. Then we have what we call unrestricted funds. These are funds which the charity has either been earned. So maybe if you're doing some sort of service delivery and you've been given the money to deliver the services, if at the end of the project you've delivered the services and if you've made a surplus that's yours to keep, that would be unrestricted funds. Sometimes you have unrestricted donations, just where people are making regular giving to the charity maybe, but actually they're not stipulating that you must spend it on anything specifically. And just kind of other general income. If the funder doesn't put a restriction on what you can spend it on, these are unrestricted funds. So these funds give more flexibility to the charity. You can spend them on what you see fit, so long as it's within your sort of charitable purpose. So these funds are probably more useful and do give certainly more flexibility. And then this final type of funds, which you probably don't have transactions occurring of these every year. It's the sort of thing which you have happen quite irregularly, but they will sit there for a long time. So endowment funds. So these are funds where at the original outset of the donor has implied terms which says effectively that these must be kept on a permanent basis and you cannot spend the original capital. So a good example and one what I see quite often is maybe in a legacy, somebody has died or something and they've left a property to a charity. And they've actually said, we want you to keep this property permanently. You can spend the income which the property generates or what the endowment fund generates, but the core original gift is to be retained in permanence effectively. The idea of endowments is effectively donors looking to create a long-term future for the charity and creating some sort of permanent income stream. So they don't want you to just be able to spend those funds when it's received effectively. So yeah, we quite often see those in properties or maybe in investment portfolios. Now, what you can't do with permanent endowments is you can't just spend the capital, only the income. The one proviso for that, I suppose, is you can apply to the Charity Commission to have that endowment lifted if there is a genuine business case. So it might be, and I have seen it in the past, where there was a permanent endowment for some property which was gifted to a charity 50, 60, 70 years ago. The charity no longer needs a functional property. How the charity operates has changed over the years, and they don't need that anymore. So you might apply to the Charity Commission in that respect to have that endowment lifted. If the Charity Commission agree with the business case for it, effectively, they will allow you to release that. But you do have to be very careful with monitoring those funds to make sure that you know what you've got there, I suppose. So starting to some of the other accounting oddities, I suppose, that we've got in charities, income recognition really is one which causes a lot of confusion with charities. Even some accountants who don't deal with charities on a day-to-day basis can get tripped up with income recognition in charities. Often we are recognising income quite in advance of when the spend is. And it can mean that we recognise income in one year and the spend in the next year. So we can have quite a mismatch in timing of when they are. And a lot of people, particularly accountants, I suppose, they've been brought up on sort of a matching concept of if we're incurring the expenditure, now I want to recognise the income at the same time and match them off. Due to the income recognition in charities, that's not the case. And actually, there is a good reason behind it. And once you understand it, it does make sense. So income in charity is recognised when we've got entitlement, it's probable, and we can measure it. So entitlement is when the control and control and rights has been effectively awarded to the charity. This can quite often be in advance of the cash. Quite often it can be when the grant's been physically awarded by the funder. They've released the paperwork, they've made it public that you've been awarded the funding, but it might be some time actually still till you actually receive the cash which goes with it. We must recognise income when it's probable. So in terms of what we mean by probable is it's more likely than not. So actually that's quite a low threshold, but it does mean that most of the time, if your funding's coming from a known funder and you've got no reasons to not expect it, we will recognise that income quite early on. And then measurement, when can we actually put a number on it? When can we reasonably measure that value of the grant? So if you think why this can cause us problems, grants and donations are quite often the ones which cause us problems here. Because quite often you will be granted, let's say £100,000, but you're not going to spend it until next year. The reason we're recognising all of that income now, not trying to match it against the cost, is the donor themselves. They have probably in their books, if they were to look at it, they've paid that money out. They're not expecting anything back for it. It is the charity's money now. It's the charity's money to choose how to spend. So what I've got is actually just a little example here about how this can complicate matters, I suppose, really. So in this example, I've got a charity which is maybe running children's day centres or something of that nature, and they've been awarded a £200,000 grant from a funder. The funder sent out all the paperwork, has said you've been awarded this grant on the 1st of March. They haven't put any stipulations on what you could spend it on. It's just here's £200,000 to spend on your children's day centre. We don't receive the cash until a little bit later, maybe the 1st of April. So just getting into the new financial year. So how much income would be recognised in the 31st of March year-end accounts? Well, if we work down the criteria, I suppose, entitlement. Are we entitled to that money, and when are we entitled to that money? We're entitled to that money when the grant has been awarded effectively. They haven't put any stipulations saying we can't spend it straight away. So we're entitled to it from the 1st of March. Is it probable that we're going to receive that money? Well, if the grant funder is a known organisation, someone like Bernardo's, for example, you've got no reason to not expect to receive that money. You've also got the benefit of hindsight, probably, when you're preparing those accounts, knowing that the cash has been received year end. So probable, I think, would definitely be ticked there. And the final one, can we measure the amount? Well, yes, we can measure the amount. It's a set amount. It's set in stone. So what we're going to do there is we're going to recognise all of that income in the 31st of March 2021 year end. But that does create your accounts looking a little bit odd, as I said. So we're going to have 1 year with a lot of income in. The chances are probably if you haven't received the cash until post year end, you're not going to have spent much, if any, of that grant in the year to 31st of March. But it's probably a restricted fund because they've given it to you for a specific purpose. So what we would end up reporting in the accounts is in this individual restricted fund, £200,000 of income and nothing spent. And then in the next year's accounts, we would have a brought forward balance and we would start reporting the spend. What we can do, though, is just subtly change the terms, I suppose, really. So the same grant, everything exactly the same. But if there was one extra little term put in there, it might change our income recognition. So if as part of the terms and conditions they actually said you can only spend it on staff costs for the 12 months to the 31st of March 2022, effectively that's limiting when we can spend the money. We can only spend it in that 12-month period. Therefore, you'd be saying we're not entitled to it back at the 31st of March 2021. Our entitlement starts when that time period starts. So we're not going to recognise any income there. So I think what probably I think that demonstrates is you have to be so careful when you've got grants and donations coming into charities, and really understanding the paperwork and the terms and conditions that have been put on it are absolutely vital. And very often it can be counterintuitive, and you really do have to go back to that paperwork and assess it. And that's one of the tricky bits is from completing charity audits, to be honest. You have a lot of paperwork to sift through to actually truly understand the terms, but it is important that it is reported correctly. Legacies are obviously unique to charities. Companies don't often get legacies from generous donors, but legacies can be even more, I would say, painful to account for, to be honest, because of how they can come in and how charities can be notified them. So generally, it is the same principles which apply. We're still recognising income when you've got entitlement. It's probable, and you can measure it. But that is so much more complicated when it does come to charities, because of how legacies are received. You might get lucky, and it might be one of those very simple legacies where you've just been left £1,000 from somebody's will, and there's nothing complex going on there. But very often, particularly the bigger charities, might be being left the residual in an estate, or they might be being left 50% of an estate. And to get to those residual numbers, you have to go through sale of property, sales of shares, paying some legal fees, paying any inheritance tax, all of those sorts of bits and pieces. So it can become very complex. But if we work our way through the criteria, I suppose, really. So entitlement is normally going to arise when there's a valid will, and it's not being contested. When it's probable, probably gets a bit more tricky, but the charity SORP does cover this, and it says receipt is normally probable when there's been grant of probate, the executors have established that there are sufficient assets in the estate to pay it, and any conditions attached to the legacy are either within the control of the charity or have been met. So once everybody's comfortable that it is probable you'll receive some money, that's going to be that one ticked. But then the difficulty really can come on the measurement piece, I suppose. That's where we come up with the biggest uncertainty. And as I say, if it's a residual where you've got to make a sale of a property, figuring out what value to put on the legacy can be really very tricky, because particularly, I mean, with property prices at the minute, if it's something which is property related, who quite knows what you might be receiving, I suppose. But what we need to do is those are ones where you just need to keep monitoring. You need to keep talking to the solicitors who are dealing with the probate and getting as much information as possible. One of the biggest difficulties I think you normally have as charities, and one of the difficulties we have as auditors, is the SORP doesn't make any allowance for the fact that you might not have all this information. If the information is out to there, the expectation is that charities should have that information. So sometimes you do need to sort of have quite a lot of discussions with those completing the probate and understanding where the process is, at what point in time you can meet these criteria. Once these criteria are met, the income has to be recognised effectively, and we must bring that income in. So it's they are one of the trickier ones for accounting, just because the absence of information obviously quite often makes it quite tricky. So the reserves policy, this is all part of the Trustees Report, and the reserves policy is a way to explain to users of your accounts what funds you've got in the charity and why you hold them. I think personally it's one of the most important bits you've got in the accounts, because very often actually there is a misconception that some charities are rich and have more funds than they need, particularly if you were to just look at the accounts without truly understanding them. So you might have a charity which has a balance sheet of £18 million, for example. Oh, sorry, I've just got a question come in here. So just load that one up. In the probate sale of property scenario, can you use the red book value in the knowledge that the sale price might possibly be higher? Yes, I think you can. I think it all depends on how much certainty you think you can get to that value. I don't. I think what there's always an understanding that you can never probably put your finger on exactly what the right price until everything has gone through. But I suppose as auditors and anybody preparing accounts, you're always working in sort of a materiality basis. Are we going to be in the right ballpark? So I think if you can put a reasonable estimate onto it and you've got enough confidence in that is the number, yeah, you certainly could use something like that. I think just going back to the exact SORP definition on the measurement. So can we reliably measure it? Yeah, if you're in the right ballpark, you probably can reliably measure it. So I think that's fine with me. It's probably one best discussed with your auditor though, if you do have any of those questions. So yeah, I was just saying the reserves policy. If you had an example charity with £18 million balance sheet, if somebody were to just look on that, they might think you're very rich. But 16 million of that might be tied up in property, which you've used within the charity, so you can't really go and spend that. Another £1.5 million of that might be tied up in restricted funds, which you can only use on very specific purposes. So you might actually only really have £500,000, which is sort of what we would say is available to spend. So I think with reserves, it's very clear that the total funds of the charity are not the same as what you've got available to spend. So what we tend to put in the reserves policy is explain to the users why you've got your funds, what you hold them for, and actually how much you think you should be holding. So we've got our unrestricted funds, those which you can spend freely. You've got your designated funds. This is a method of the trustees and management showing to users of the accounts that actually you have got plans for these reserves. So it might be that you've got £500,000, but actually if you know you've got to do a big capital renovation on your property, which is going to cost £300,000, you can effectively ring fence that money aside, showing everybody looking at the accounts that you've got plans for that money and that you're not just holding funds for the sake of it. And then free reserves is sort of where we get back to this is the money which we haven't set any specific plans for. It's not restricted. It's not tied up in fixed assets. This is the money that we've effectively got free to be able to do what we want with. And what you want to do in your reserves policy there is very much set what your target of your free reserves is, because every business, every charity has a level of risk in terms of financial risk around kind of income future, actually generating that income, winning those grants, winning those bids in the future. Costs, there's always a level of uncertainty about what costs could come in. So there's always a level of almost what I would call your rainy day money, which every charity is going to want and going to need to hold. That's more or less going to be the basis for your free reserves. If you've got more money than that target, you can look to spend it on something on a charitable activity, because I think it's very obviously the aim of the charity is not to build a strong balance sheet, is not to build funds, it's to spend money and achieve charitable purpose. So understanding what your minimum level of reserves is then allows you to see what funds you have got available to spend most efficiently on your charity beneficiaries, and that really is what it's all about there. But getting those policies right is absolutely key, particularly if you're a charity which puts in lots of funding bids to grant funders and donors. If they look at your accounts and your policy is we need £200,000 and you've got £500,000 in free reserves, as a donor I might be saying, well, there's other charities who need the money more than you. Whereas actually, if I go back to that 500,000 example, if I'd said 300,000 of that I do need for some property repairs, 200,000 is my kind of my baseline. I just need to be comfortable to keep the business running. Actually, that's saying I haven't really got any funds available day to day, so I've got a good business case for putting in this policy, this grant. There's really good guidance in the charity SORP about writing a reserves policy. I'd recommend you have a look at that. Also on our website, we've got some articles, and we'll have a link to that one later, which you can have a look at. Unrestricted funds and free reserves. Yeah, so the difference between the unrestricted funds and free reserves, I suppose. The unrestricted funds could be any funds which you've got which haven't been given with a restriction. So they might include funds which are tied up in fixed assets. So you're building, if you purchased your building using your own cash, not with donated money, for example, that is an unrestricted asset. But obviously a building, you can't go and freely spend. The only way you could spend that would be to sell the asset. What I quite like to do if I'm preparing charity accounts is actually designate some of those, show people that it's put aside. Those funds are tied up in fixed assets, for example. We can't spend them. I hope that answered your question there. And then trustees report, just as a point on that, I suppose, really, it is so hard to get your message across to users of the accounts. So the trustees report, there's a lot of requirements for it, and it can end up quite wordy, but it is a key communication document. Often, again, if you're putting in funding bids or talking to the public, they might actually go and look at your accounts before deciding whether to give money to your charity. So getting your trustees report properly drafted is so important, and putting the time and the effort in there to make sure it is putting the right message across. Really, it's your sales pitch, I suppose. Really, it's where you can talk about all the good work that the charity does, what achievements you've made in the year, also what the future's looking like for you, where you are going, also explaining the core financials in your accounts. And trustees reports, particularly, probably most charity or a lot of charities are March year ends. So March 21, March 20 year ends, we had an awful lot talking about the future and the impact of COVID and what that was meaning for the charity. March 2022, again, COVID's been a big piece, but trying to explain the results and has actually been quite hard for charities, because it's just been such an unusual year. But it is such an important document. It is your sales pitch, effectively. What you can also do is thinking about things such as impact reports, because in a big document, which is 10-15 pages long, largely of words, it's very easy to have those nice messages sort of lost in the detail. So quite a lot of charities will also look to do sort of a supplementary sort of impact report, something much more pictorial, maybe using a marketing team or somebody within the charity to pick out some of the key numbers, some of the key information from the year-end accounts, but make it in a much easier to digest sort of document for those. And I think that's a really nice idea, particularly if you're somebody who does lots of fundraising with the public. The public probably won't read your accounts, whereas if you can give them a 1 or 2 page which says we've helped this many children, or we've helped this many adults in the year, we raised this much money through the public, we spent this much on this project, it's just nice. It makes it something nice which you can talk to people about, and I think it's a really good idea, and one which I would fully encourage. Yes, the trustees report, sometimes called the annual report. It's incorporated into the statutory accounts, Claire. That's correct. Can be a big document, though. I'm sure you probably, if you're thinking of the annual report, you probably drafted it a few times over the years.